Welcome back, folks. This is price action model number 10, trade plan for a swing trading model. 50 to 75 pips per week. All right, ICT price action model number 10, 50 to 75 pips per week trade plan swing trading model. Okay, our 5 stages of trade plan development: preparation, opportunity discovery, trade planning, trade execution, and trade management. Preparation. Note all medium and high impact events for the markets that you are following. Study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Okay, for the IPTA data ranges, we'll be returning to the 20, 40, and 60-day look back, any one of those ranges, for a potential liquidity run for both entry and exit. So we will determine the IPTA data range for the last 20, 40, and 60 trading days. We do not count Sundays. Note the highest high and the lowest low in the past 20, 40, and 60 trading days. This is your current dealing range. Inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? Below which old low? Above which old high? We look for a PD array in the direction of the weekly range bias. We anticipate price to move to a PD array that would support our weekly bias on a day and news release found on the economic calendar for the current or next trading week. This volatility injection is what we wait for. This would be a run based on a low resistance liquidity run condition. Opportunity discovery. We look for 50 to 75 pip ranges that would enable a run to buy side liquidity when bullish institutional order flow is present, or target the sell side liquidity when bearish institutional order flow is present. Now the chart to the left here is the idea that you want to have when you look at your charts. There's a range here that indicates a 50 pip range relative to this chart scale, and one that is 75 pips in range. I primarily look to take the bulk of my weekly objectives at the 50 and use the 75 as some kind of remainder of the initial positions. Okay, in other words, when I take my short-term or swing trades for 50 to 75 pips, I'm looking for opportunities that are going to potentially pay out at 50 pips as a bulk, okay, or the highest percentage of leverage I'm holding. In this model, I'm going to give you 2 orders. Okay, so you're going to be doing one that gets you in with 50 as the objective, and then the other may not really get to 75 pips, but that's usually the best case scenario for this model. Trade planning. When the market is poised to decline, we want to look for a convergence of both manipulation and price, opposite to our trade bias, at a time the economic calendar suggests a volatility injection will likely unfold. We will short premium buy-side liquidity pools. When the market is poised to rally, we want to look for a convergence of both manipulation and price, opposite to our trade bias at a time the economic calendar suggests a volatility injection may likely unfold. We will buy discount sell-side liquidity pools. Trade executions. When we are bearish, we will anticipate a 15-minute chart buy-side liquidity pool raid for entry to form from a retracement higher during London Open and or New York Open kill zones. When we are bullish, we will anticipate a 15-minute chart sell-side liquidity pool raid entry to form from a retracement lower during London Open and or New York Open kill zones. Short trade management. When we are entering a short, we will place a sell limit order. We will execute with our demo account. We will use the PD array convergence minus 5 pips as our entry price when using the sell limit order. Long trade management. When we are entering a long, we will place a buy limit order. We will execute with our demo account. We will use the PD array convergence plus 5 pips as our entry price when using the buy limit order. Short trade management. When we are entering a short, we will place a limit order to take 50 pips as our objective on a single position. A second limit order will be used to capture anything above 50 pips and up to 75 pips. We will use two orders to manage the trade idea. If you capture a 75 pip objective, close the second order via limit order and wait for another opportunity. Long trade management. When we are entering a long, we will place a limit order to take 50 pips as our objective on a single position. A second limit order will be used to capture anything above 50 pips and up to 75 pips. We will use two orders to manage the trade idea. If you capture a 75 pip objective, close the second order via limit order and wait for another opportunity. Stop loss management. When we are in profit, 50% of our expected objective, stop loss can be reduced by 25%. When we are in profit 75% of our expected objective, stop loss can be reduced by break even. Money management. Position size calculation formula. Position size equals account equity times R% divided by stop loss in pips. Position size is the amount of leverage your trade or trades assume. Account equity is the total amount in your trading account. R% is the percent of risk you are willing to take on per trade. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R%. Our example here, now we're going to be using a $10,000 hypothetical account, and risk per trade is 1% now, or 10,000 times 1%, which is 100 US dollars. The stop required for this model, 20 pips. So in micro lots, 1K each is 10 cents per pip. So if we're using 20 pips as a stop times 10 cents, that would equate to $2 US. So $100 risk divided by $2 per pip equals 50 micro lots per trade, or 1% of the account equity. Always round down. In this example, using the same hypothetical $10,000 account, 1% risk, or $100 risk per trade. The stop required is 20 pips. In mini lots, that's 10K leverage, or $1 per pip. 20 pips times $1 equals $20 US. Then $100 total risk divided by that $20 gives us the leverage of 5 mini lots per trade, or 1% of the account equity. Always round down. And finally, using standard lots where $10,000 of our hypothetical account balance, 1% risk, $100, 20 pips required. Using a standard lot, it's 100K leverage, or $10 per pip. If we're using a 20 pip idea or framework and each pip is worth $10, it's $200 risk. That's immediately over top the amount of risk that we can have for 1%. So in this case, $100 divided by $200, it's not applicable for standard lots. If your demo account takes a loss on a trade and it is the full R% you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes and stair steps higher, not with a jagged or deep decline. Start backtesting. Collect multiple sample sets with this trade plan. If you are unclear about some of the process, rewatch the lessons on this price action model. I will provide sample sets, but do not rely or wait on mine. Dig into your charts and study what is provided here. Good luck.